What has to occur in price action in order for a wedge to form on the chart? What has to happen in price action in order for a wedge to form on the chart? I'm waiting for some answers. Mike Schumann is saying decreasing size of candles. No. Pip Thief is saying higher lows and lower highs at same time. Rob Rice is saying lower highs and higher lows. Very good. Jay is saying consolidation type of thing. Jay, when we're done with you, you won't be saying a consolidation type of things. You'll know the exact kind of candles you need to make these different patterns. And Sean is saying the next two swings cannot close above or below the first in a sequence of three. I don't know exactly what that means, Sean. I think you've kind of got the idea, but I'm not exactly sure. Um, the Brishu is saying the candle gets smaller. No, that's not what we need to see to in order to create a wedge. Okay, uh, I'm going to just go over it quickly. I just want to see Phil 919 is typing in an answer. The candle gets small. Okay, so Phil, stop the typing. All right. Now I'm going to touch on this briefly for Jay also. In a downtrend, Jay, we have a very repeatable pattern in downtrends. Okay, it happens in uptrends. You'll get 3 to 5 candles of the same color generally in the direction of the trend. And then when a pullback starts, you'll generally get 2 to 3 candles on the pullback. So you see price went down, and then on this candle, it pulled back a little bit. And then we got 3 to 5 candles in our direction again. Did you see that, Jay? And then when price started to go back the other way, it went back 2 to 3. Okay, it's a repeatable over and over and over again. What creates a wedge is when price cannot make a new high and it cannot make a new low. Okay. Well, no, Jay, the downtrend, how a downtrend behaves has nothing to do with the 15-minute price track. I'm talking about just how a downtrend behaves, and it's the same on every pair. It's the same on every stock. It's the same on every futures contract or any options contract. It's exactly the same. Price goes down 3 to 5 candles in your direction and pulls back 2 to 3 candles. That piece of it came from a guy named Oliver Velez, but they never really amplified very much on how to take advantage of it. And that's when I brought my own thinking into it and added some stuff I gathered from other people. Okay? So now here we have an uptrend. Okay? We've got a few candles in a row in an uptrend. And now here's our pullback. Okay? And now we're starting the next leg of the uptrend. So in order for this uptrend to continue, Jay, we have to get candles that close above this high. Do you understand that? In order for this uptrend to continue, we have to get closes above this high. All right, we didn't get that. Okay, then we need to get, let me just get rid of these lines. Now, in order for this downtrend to continue, Jay, we have our downtrend, here's our pullback. When the market pushes back in the direction of the downtrend, we have to get a close below these candles. And you see that this push down did not close below this low. Do you see that? And then we had a push up to go long, but that push up could not close above this high. Do you see that, Jay? So when you can't make a new high and you can't make a new low, it almost invariably makes a wedge. Do you see that? And what I'm using for the bottom of the wedge, Jay, are these three wicks right here. You got that? Because all three of these stopped pretty much within a pip of each other. Do you see that, Jay? So if I can't make a new high, if this push up can't give me a new high, this push down can't give me a new low, it's a wedge. And you didn't see last week's lesson. I just want to straighten this out a little bit. Now understand, yeah, if I don't draw these dead on perfect, you know, I'm trying to get to like bigger points, and Mike Schumann will complain if I don't draw the trend lines dead on perfect. Okay? Now, how we trade a wedge, and this is a simplified version of trading a wedge, is we're waiting again for a close below the bottom of the wedge. Okay? And then what we want is to put our stop loss of the wedge at the last touch of the wedge on the other side. So this was the last candle. These two guys are the last ones to touch the wedge on the top. So we want to put our stop right there. And our risk on this trade would be the distance from our trade entry. And in this case, it's 6 pips. Okay? Very tiny risk. Very, very tiny risk. But we have a chart-based reason for entering the trade. And again, hear what I'm saying. The way I teach this is that you have to have the full pattern. All the candles have to cooperate. If they don't cooperate, you don't have a pattern. When we look at the price trap, you see this, this is not a real price trap. Let's go back to this price trap. Remember, right now, for the rest of your life, you know that you need a minimum of 3 candles to work together to make a price trap. You'll never forget that. That's very, very easy. Do you see that? Well, Mike, if it's unclear that you can't find them in real time, Mike, then you don't have the rules, Pat. You don't have it locked in your brain what the rule is. Do you understand? Because you can't get just 3 candles working together. That's it, just 3. So if you can't see it, Mike, in real time, that's because you may not be looking at the rules. You may be interpreting something that I didn't say. I keep this super simple, really, really simple. Yeah, Mike, Mike is saying I see so many of the 3 candles all over. Yes, Mike, I agree. They're all over the chart. That's why it's one of the 4 building blocks of price action. It's consistent and it's repeatable. But I also said location, location, location. It's where it happens is what gives it its power. Okay, it's location, location, location. It's where it happens. My initial thing is for you to be able to see it first. Once you can spot these, now that you know what to look for, I could put 8,000 indicators on this chart. I could clutter this chart up like a mess. But someone that understands price action, you'll be able to look through every one of those indicators directly at the candle and know exactly what you're looking at. Okay? So Mike is saying, but I seem to take the wrong ones. So where is the right location? We didn't get into that, Mike. I'm teaching this in segments. Okay? Because what happens is if you try to absorb too much too fast, you end up creating a bunch of chaos. The first thing is to get you to be able to see the price trap. Then the next thing is to look for chart-based evidence, giving you some clues as to directions. Well, indicators are really, really good. Now, I like indicators. Now, Jay is saying he hates indicators. Indicators made him lose money. If you match up the right indicator with the circumstance on the chart that it was designed to measure, indicators are super powerful. But most of the time, at least in my experience, I come across traders that were never taught properly what the particular indicator is they're using. They weren't taught what it was designed for, and more often than not, they're taught to use it in a market condition that indicator wasn't made to amplify. Do you understand that? Once you understand what it was designed to show you, then you look for that type of market, then that indicator can really be powerful. But more often than not, people are not taught about where to use the indicators. They think that you can use stochastics in every market. No, you can't. You know what I mean? They think they can use CCI in every market. No, you can't. They're designed for specific things. Okay? So this was three methods for getting into this trade. We had, and again, I'm going to go over it again, and thank you. I want to thank everybody for bearing with me with all the repetition. Okay, we had the trend line break was method number one. Okay, we had the price trap right here, which was method number two. We had the wedge, which was method number three. And I'll show you a fourth method, and there are several others, but I'll just leave it at the four. And I'm not going to amplify on the fourth because it does involve one of those indicators, Jay. Okay? The fourth way is to take advantage of another chart pattern called a 1, 2, 3. And the 1, 2, 3, this is spot number one, that X. Okay? This is spot number two. And this is spot number three. It's an old school pattern, been around 100,000 years, but it's a 1, 2, 3. When you see that set up, excuse me, when you see that pattern set up, now I'll show you, I'll grab an indicator, and this is where if you use the right indicator in the right circumstance, you can make some money. I'll grab the Fibonacci expansion tool, and I'll connect the 1 and the 2, and then I connect the 2 to the 3. And now these become profit targets. I didn't put in the 200. Oh, this red line is almost right where the 200 profit target would be. So you see here we have the 618, the 100, the 1618, and just about where this red line is would be the 200. So had I entered, let's say below this line, this would be profit target number 1. This would be profit target number 2. Does everybody see that? Okay, this is how you use the right indicator under the right circumstance to make money. You don't just grab every indicator. You look at where am I on the chart and which indicator gives me the best example of that. Now there is a bit of a Gartley here. I'm just going to draw it, but I'm not going to talk about Gartleys. That'll be down the road a bit when we talk about Gartleys and butterflies. And for those that are unfamiliar, don't worry about it. This is kind of sort of a butterfly here. You Gartley guys, do you agree with that? Okay. Guys, anyone here that does Gartleys? Would you agree that this is, kind of the idea with the Gartley? It's not dead on perfect. Okay, but you get the Gartley, and this is supposed to be the butterfly, this whole thing you're looking at. It's a very different discipline, and something that we'll get to in a minute. Okay? Phil, does that make reasonable sense, what I'm saying here? I'm just showing you that there's 100 ways to get into the trade. And I want you guys to keep in mind, and I've said this a number of times, if you have a method, if you have a system for getting into trades that keeps your risk low and your profits high, use it. Don't listen to anything I say. If you've got a system that you like, that works for you, stick with it. Yeah, Kimberly, it's kind of an M. It's a kind of M, the Gartleyan butterfly, but the math around it is a bit different, Kimberly. And George is just typing in harmonics. And it is something, it's considered a harmonic pattern, Kimberly. but it is a bit of an M. Okay, and when we get into when we get into market reversals, like how do you know when the downtrend is over? How do you know when the uptrend is over? Then we'll come back and we'll talk about the M or W pattern. All right, so now we have four ways to get into this trade below this point, which is the low of the 15-minute candle. Okay, Richie, Lou, I've been using 10MA. No, I'm not adding a bunch of indicators here, Rich. We'll get into that. All has to do when we get into support and resistance. Richie's saying he's been using a 10MA, a 10 moving average for pullback, for trading pullbacks in the direction of the trend. And that's one of many, many methods for how to trade a trend. But I'm only really trying to concentrate on just the candles right now. I don't want to add anything else to the chart, because you should be able to make money with just candles and straight lines. And that's my goal here in these next week or two. Okay? Yeah, George, if you have some harmonic stuff, drop it in my email box and you and I can talk about it later. Okay? And also, Phil919, if you have an ebook or something from Gartley, if you could drop it in my email, I'll take a look at it. And I may have it already. I've got almost 8 terabytes of trading books and videos and courses from pretty much everybody out there. And I stopped aggressively collecting a few months back because I saw absolutely nothing new coming out, just rehashes of the same old stuff, and a lot of it actually not worth very much. All right, yeah. So if you guys have something that you want me to amplify on another time, drop it in my email box. I'll take a look at it, and then we can build a lesson around it. So again, if you have a method that you really like and it gets you into trades safely with minimal risk, keep doing it. I'm simply showing you how to pinpoint where to get into the trade to keep your risk at a minimum and you take profit at a maximum. All right? And what I'm teaching you works on every time frame. We're here on a 1-minute chart using 5 and 6 pip stops, looking for 18 to 20 pip moves or more, because the day is not over yet. And on any of these trades, our stop loss would have been pretty much in this general area here. No matter which of the methods we used, our stop loss would have been in about this area. Okay, so I mean, price has already moved 30 pips in our direction, and our stop hasn't been hit, and the day's not over. It's still very early on in the day. Okay, so any last questions on that before I move on to something else? And let me get rid of these lines. Now, you've heard me talk about location, 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 and you've heard me talk about chart-based evidence. Okay. Are you good with this, Jay? Any questions so far? I don't know how much experience you have with candlesticks, Jay. I didn't test you yet. I need to be sure that you understand basic candles. You have none. Okay, then we'll get to that separately. All right. Okay, you know the terms. Okay, a lot of people know the terms of candles, but they don't know the psychology and reasoning in the candles. And I'm going to go back to the 15-minute chart to touch on something here. Now, I want to answer a part of Mike Schumann's question, and I'm going to touch just a teeny tiny bit on the kind of DNA of candle movement. Okay, and it's stuff that's been around, but I've tried to find a very, very simple way of explaining it so you can all grasp it. Okay, my bias on this price trap was short. Okay, and this happened live in front of us, and it went short, and all 3 of my entry methods would have given us the profit target based on the concept of trading a price trap. All right. So every one of these entries, either the entry 1 tick below this low, or the entry at the open of this candle after the close, or the sniper trade, didn't matter which entry you used, all of them would have given us a profit target of twice the width of the box. That's number one. Number two is location, 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 and chart-based evidence. All right. When I look out here to my left, I can see that there is a price point that none of these candles could get above. I'm going to mark that right here. Does everybody see that? See how we have a flat top here on these two candles? Okay. Now let's look at price action. We have an uptrend here. We have a huge candle that started this drive up. And again, we're going to add up price action. And I like to call it DNA, break it down into the smallest common denominators. So all of the traders in the world trading the euro US dollar, all of the traders in the world pushed price up on this one big candle. Okay? Then on the next candle, well, wow, the body of this candle had almost nothing in it. They were still kind of excited up here, but when they got up here, the sellers pushed it back. But the sellers didn't have enough strength to push it back into a negative candle, into a white candle. You see that? So they were still buying energy here, but not enough to make it negative and just enough to make it positive. But you can see we went from a big